Prabhat, hi, morning. Good to chat with you today. Now, recently one has seen two encouraging trends. A, the FDI flows have been strong. B, domestic investors also have been putting in money into the market. How important are these two trends and are they likely to sustain going forward as well?
Well, I think in FDI obviously tells you that the real investors which are investing in real economy obviously are taking a much more positive view of the Indian economy and the opportunities offered therein, because these obviously people are investing in plants and businesses, and therefore tells you that they are in a position to take clearly a much better view of Indian economy. Portfolio investors obviously worry a lot more about short-term factors. So clearly very positive, and because the fact is that if you get technology, if you get the kind of expertise that comes with the FDI flows and the kind of stable capital that comes in, that's quite positive. Domestic flows have typically not been the determining factor in the marketplace, except the fact that in this cycle, in the last 3-4 months, despite the fact that foreigners were sellers, the market has gone up largely on the back of domestic flows. So that I think is quite a positive development, because we have always talked about potential of domestic investors. It's never been realized. Hopefully, given the fact that gold prices are weak and the investment demand is falling off there, and the fact that property is no longer a safe haven for investing, means that we'll continue to get these flows, and they will act as stabilizers for the marketplace in case the foreign flows are sort of volatile.
Prabhat, where do you see the markets headed from here on? I mean, are there legs for this recovery to go on further?
So I think the markets, in our view, will go up because of two things. One, we believe that there will be a recovery in earnings. So if earnings are doing well, logically speaking, compared to where we are, and the expectations become better, then markets should go up because of the earnings themselves. And secondly, because if the growth expectations change on the positive side, then it's likely that your multiples will also go up. So we think that both from earnings support, which has been very weak in the last few years, there will be more support going forward, and then we believe that there will be some order multiple expansion also.
Morning, Prabhat. Nikunj also joining in. Now, earnings season has been fairly muted so far. When do you see strong earning recovery, and which sectors do you think will lead the earnings recovery?
So I think what will happen is that domestic cyclicals, especially with inputs of commodities, will do well, because volume growth is showing some signs of recovery. Input prices are obviously helping. I think financials will recover, because financials, you have seen such a big impact of NPA recognition. As that continues to come down, there will be a recovery in earnings there. So I think it's all domestic cyclicals like autos, some bit of industrial, some parts of industrials. You've seen a massive improvement, for example, in oil company earnings because of the subsidy issues getting sorted out. So these companies as well as financials.
Now, although Prabhat, you are overweight financials, we've seen low commodity prices impacting steel sector. How worrisome is this for the financial sector, which has high exposure to steel and metals at large?
So it's a question. It's obviously a worry, and I don't know whether there's a quick solution, because if the global situation remains like this, then it's very hard to see a big recovery in commodity prices. And that essentially means that the banks which have lent to these sectors will have an issue, and that has to be sorted out either by taking write-offs or by infusion of capital. Some part of that, I think, is already happening. We have seen some write-offs, some provisioning, and we are seeing some capital infusion by the government. So if the government can take care of capital by infusing it, it will become less of a worry for the economy.
Prabhat, the single most important question for economy and for market watchers and for investors is, when will the investment cycle pick up? And do you see sectors like road, railways, etc. to contribute to the investment cycle recovery going ahead?
So investment cycle, we think, recovers next year or towards the end of this year. It doesn't recover, and it will not be a sharp recovery. It will be a gradual recovery, just because we really didn't. We almost had destruction of the full cycle. So recovery therefore takes that much time to come through. And also some of the large driving sectors of investments, for example, metals and power generation, etc., will no longer be drivers. So you have to build something from scratch. So therefore, it has to be new sectors. As you said, railways is one. Roads is another one. It's an old sector, but there is clearly some, there's a fair amount of action happening in the ministry. and you will see that recovery come through. So you will see now roads will be easier because road has been a sector where the models are fairly clear in terms of investing. All you need to do is streamline the process. Therefore, road has been first to recover. Railways might take slightly longer because railways, there was no private sector or there was no actual investment happening. So to build a pipeline of projects and then start executing them takes that much time. But I would think that public spending is where you will see the first fillip to the investment cycle, primarily because the government has created fiscal space and they seem to be very committed across ministries to start a public investment cycle.
Prabhat, so what about consumption sector? I mean, so far auto sector margins have been, pretty healthy despite muted sales. How do you see consumption plays like auto, FMCG, etc. perform going forward?
There will be recovery. The question is how much you pay for the recovery. So that I think is a totally separate issue. But if the economy recovers, usually everything recovers. The recovery pace in consumption will probably be slower than what happens in investment because investment cycle has come down dramatically. So the ability of the investment cycle to rise from the bottom will be probably higher in terms of percentage growth. Consumption never collapsed to that extent, therefore will probably be, in relation might look slower, but compared to its own pace, I think there will be a recovery across the sectors.
Okay, and Prabhat, final thoughts really. What are the sectors that you are broadly overweight or underweight on?
So broadly, we like financials. We have liked technology. We have liked autos, industrials, but clearly with stock picking bias. We have liked oil and gas, especially downstream. We have not liked metals. Consumers, so FMCG, not really autos, not discretionary consumption, primarily because of multiples, pharma again because of multiples, telecom because of competitive issues. So these are sectors. There's been a long-standing sort of portfolio bias for us. It's not changed that much, and we will continue to sort of have that sort of view.